The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and thank you all for joining us and welcome to the March 16th version of the 12 points webinar. This one called the Taxman Cometh, Strategies to Minimize Your Contribution to the Government in the Form of Taxation. My name is Christopher Cahill. I am very pleased to have with me today Chris Lee, partner at Lee and Crowley. And he will be taking us through changes in the tax law and things that we should be paying attention to now, not only now, but also throughout the balance of this year. So as you see on this screen here, this is my smiling face. I'm an attorney, a certified financial planner, and a chartered advisor in philanthropy. I'm a partner and principal here at 12 Points Family Office Services Group. I specialize in working with affluent clients on all manners of complex planning needs. With specific expertise on trust and estate, gift planning, business succession, legacy, and philanthropic planning. But as I said, I'm really pleased to have, wrong direction, Chris with me here. So Chris, tell us a little bit about yourself.
Thanks, Chris. Yeah, so my partner Ryan and I started Lee and Crowley almost 5 years ago now. We both came out of a large regional CPA firm and then an international firm, and we took that expertise and brought it down to our client base and really with a focus on service for our clients and getting answers for questions and particular needs that they have. And so this really kind of fits into our firm's wheelhouse of getting strategies in place for tax planning, for, as you mentioned, business succession planning, all kinds of facets of things around tax planning and accounting wise for businesses. So looking forward to running through this with you today.
Excellent. And thanks again for your time, Chris. It's really important to us and to those participants here today. So to all of you out there, we're going to try to be as efficient as we can be with our time. We really like to get these things kind of done in the course of a half hour. We will leave some time for questions at the end. We typically get a good amount of questions. We are recording this as well, and we'll post it to the 12 Points website and share it with Chris so he can get it out to his folks as well. But know that if there's any specific questions that for whatever reason we can't get to during this presentation, you'll have Chris's email address at the end, and I'll share his contact information and mine. And we'll be able to hopefully address any and all questions that you might have. So certainly feel free to reach out. We're appreciative of your time. We recognize that you have many, many other things that you could be doing today and appreciate you joining us here. So let's start out, Chris, by talking about the world of W-2 employees, which so many of the folks on this presentation are. How do employer benefits impact personal taxation for these folks?
Great. Yeah. So the biggest one, I think the easiest way to reduce taxable income for people that don't own their own businesses or don't have the advantage of allowing, expenses against their income as a W-2 employee is to maximize retirement plan contributions. And so the first point being the 401k. Others may have, 403b plans, some other type of retirement plan, but pre-tax contributions that are your money going into a plan and able to grow over a period of time without you paying tax on it until you take the money out of the account. So current period, if we're talking tax year 2021 or tax year 2022, you putting the most amount of money into your 401k or retirement plan takes away from taxable income in that period. Now, you're not giving the money away, it's still your money. You just now defer that into a tax advantaged account that years from now you pull the money out and that's when you pay the tax on it.
So Chris,
and then other things that
probably a good time to spend just a second talking about the differences between traditional 401k and Roth 401k. So, we're here trying to minimize taxes and most people are focused on current taxation. So what you just described is that world of a traditional 401k, meaning the contribution would be tax deductible. But let's talk about contributing to a Roth 401k. Can you walk us through what that looks like and how that would differ from a traditional 401k?
Sure. Yeah. So the Roth, there's two types. There's the traditional 401k, which is pre-tax money, and then a Roth is post-tax money. So when you pay tax and you have $10 in your account at the end of the year, that's considered to be post-tax money, meaning you've paid your percentage to the IRS and the state, and whatever's left over, you're free to do as you choose with.
Mm-hmm.
And so that money is then able to be put into a Roth IRA. And at that point, that balance or that account grows over a period of time, and you can take that money out tax-free because it's considered that you had already paid your tax on that.
Right.
And so the caveat or the catch-22 of those plans is there are adjusted gross income limits around making a direct contribution into a Roth 401k or Roth IRA. And there's also some limits around if your employer's 401k plan doesn't allow for Roth contributions, mm-hmm. and you're covered by an employer's 401k plan, we then have to do some interesting, there's a Form 8606, which is a non-deductible IRA form that gets included. But there's ways around it. But in particular, there are some nuances to a Roth, putting money into a Roth IRA that don't necessarily apply as similarly to a pre-tax 401k.
Yeah, perfect. And I would just simply add to that as I think many of you know, you're probably participants in 401ks that we manage here at 12 Points. Most employers these days are offering 401k options that are Roth, and there's in fact no income limitation on that. So those of you that are making good salaries can and probably should be thinking about Roth, especially if you're younger. Of course, it won't reduce your current taxes today, as Chris indicated, but you would get the benefit of the tax-free growth on that going forward. So that's something to contemplate, and we're obviously open to talking to you all about that at any point in time. So sorry to take us on that tangent, Chris, but let's kind of get back to it. So the other options on this page, other ways to reduce taxable income, what would those be?
Sure. And so the next 3 points kind of similarly react to the same piece, that childcare is expensive. And so if most companies have dependent care benefits, which you can get up to $5,000, that's pre-tax money for expenses paid for childcare that theoretically you're going to be paying anyways. And so why not get that same amount of money and not pay your, whether it be 24%, 37% to the government before paying those expenses? It allows you to get that money pre-tax. So the childcare, that fourth point is that one. And then the HSA and the FSA, Health Savings Account and Flex Spending Accounts, apply similarly, that many of us have healthcare expenses during the year, whether it be, getting glasses or contacts or some type of medicine, whatever it may be. These accounts allow you to put money into an account, or allows you to put pre-tax money into an account to spend on qualifying expenses for medical needs. So, you go to CVS and you pay your $100 for your contacts instead of, again, paying 37% to the federal government before paying your $100. You get that pre-tax money, which it's money you're going to spend anyways. You're just saving the contribution on the tax side of it.
No, great point. And, one thing that's overlooked by many folks, unfortunately, is the value of the health savings accounts. So the HSAs, those funds that you contribute in there, they can grow tax-free for as long as you need it. So know that you don't need to use it in the current year. Like the FSA, typically a lot of us have had those in the past where you contribute to it and you're running around at the end of the year making sure you spend that money. You don't need to do that with the HSA. So for many of our wealthier clients, it's a wonderful way to put additional money away for those future healthcare needs. It doesn't need to be current expenses, is my point. So great stuff there. Thanks, Chris. And how about withholding? That's something that's just so perfunctory for people, but I think it's a huge, huge opportunity.
Yeah, that one comes up a lot, especially in new clients that come to us. They say, I'm a W-2 employee, I have nothing else going on, and I continue to owe the government every year, and I don't know why. And so a lot of times it's centered around structure of their compensation, that if you have a heavy bonus or a heavy commission structure, your employer, most of the time or some of the time, withholds at a flat 20% on those commission and bonus checks, because the payroll software calculates it, and that flat 20% for the majority of Americans is a sufficient withholding amount. And so there doesn't end up being any tax due at the end of the year. But for high earning individuals, people that make, well into six figures a year, your effective tax rate is going to be higher than that 20%. And so every check that you get, you're under withheld by 7, 8, 9, 10, 17%. And that's why continually, regardless of the fact that you have single zero on your W-4 form, the withholdings are under withholding is because of the structure of the compensation being bonus.
Excellent. Excellent. So certainly something to pay attention to and to revisit rather regularly, we think. Now we're going to continue forward here. Easy for me to say. There we go. Independent contractors and business owners. They have different options, right, Chris? So let's talk about the things that they can do themselves to address these questions.
Right. And so these go, when we look at employees, really the only thing that we can control is the number on the W-2. But when we look at independent contractors and business owners, we can control both expenses and revenue, meaning on this accounting method change on the first one, if you're a cash basis taxpayer, what that means is you only pay tax on cash that you've received in your account and cash that you've paid out of your account. So it's a little bit easier for our clients to understand what they're paying tax on because you deposited $100,000 in your account. That's what you're paying tax on. Versus accrual, a 30,000 foot level is if you bill someone during the year, it theoretically is income to you. And vice versa, that if you get a bill, it's in your payables as of year end, it's a deduction. And so using the accounting method change, we can adjust legally the amount of revenue that goes in and out of the business. And so this isn't an annual accounting method change. This is something that when we look at the structure of the business, the cash flows of the business, the size of the business, there are revenue thresholds that restrict our ability to change these things. But when we look at those, the accounting method change allows us to not only adjust total income, it allows us to adjust expenses too, meaning if you're a cash basis taxpayer, a lot of times what you'll do is you'll look at your year end and say, all right, I'm going to owe X, Y, or Z in these bills. Why don't I pay them before year end? Because I'm going to get the deduction against my current year taxable income for those.
Excellent. Thank you.
And then the next point, the retirement plan, right? So that goes into strictly our expense bucket. And so when we look at our expense buckets, we now have, instead of just the 401k and the Roth that we talked about for business owners, we can look at things like defined benefit plans, which are, what people have thought of for years as kind of a pension plan. So instead of the defined contribution, which again is more your wheelhouse than mine, but instead of the defined contribution into a plan, a business owner can say, I want X, Y, or Z dollars based on, historical earnings, et cetera. And using 12 points on an actuary, they put together a calculation that says, okay, to get that, you have to put X, Y, or Z $100,000 a year into this plan to get there. And the business picks that up as a deduction.
Right. And those vehicles are just so powerful to business owners, especially now in the face of rising tax rates and potentially even more so in the future. So we're definitely seeing the resurgence of the defined benefit plan for business owners. So definitely something to keep in mind. Let's talk about the healthcare and child reimbursement and spending accounts for them as well. I mean, pretty similar stuff, right?
Yeah, pretty much the same plans. It's just that the benefit of it's both a benefit for their employees and it's also a benefit for business owners. And so money that goes in, employer contributions that go into those accounts are non-taxable to their employees. So their employees are picking up $100, $200, $1,000 of benefit, all while not paying any expense. And the business owner gets to deduct those expenses or those payments against their taxable income.
Perfect. And we all know that so many people have been working from home, unfortunately, over the last several years. Let's talk about that big old home office deduction.
Yep. And so the last two go together. The home office deduction is for the business owner themselves that they've been working out of their home. We basically look at the total square footage of their home and the square footage of their office, which the legal verbiage from the IRS is exclusively used for trade or business.
Mm-hmm.
So if you're just operating your business from the coffee table in your living room, probably not a good candidate for home office deduction. But for those that have, a room in their basement or a room on the first floor or even a spare bedroom that has their desk in it, is exclusively used for their office, we basically look at that on a percentage basis over the total square footage of the house, multiply that by the utilities, the mortgage, the property taxes, the carry cost of the house,
Mm-hmm.
and then we calculate the deduction against taxable income for those expenses.
Excellent. Excellent.
And the accountable plan is almost the other side of that. So we've had more than a few of our clients, and both business and employees, that have come to us and said, "Hey, Chris, I'm working from home. Is there anything I can get for a deduction?" And so go back to 2015, 2016, there were unreimbursed business expenses that were able to be deducted in certain cases by taxpayers. And the tax code rewrite in 2017 got rid of those. And so there is the ability for business owners, through the use of it's called an accountable plan, that there's a plan structure. The expenses are structured. It's not just, Chris Cahill, I'm going to give you $10. Chris Lee, I'm going to give you 20, and this is your reimbursement here. There has to be some structure to the plan, but it allows for a business owner to reimburse their employees for costs of working from home. And you can, in certain cases, it's not taxable income. If you're just handing money to your employees for reimbursements, you can get yourselves caught up into issues in terms of compensation. Basically defense compensation.
Excellent. So let's talk about charitable donations, right? Obviously some big changes here over the last several years. Let's talk about things that maybe used to be deductible, like those old $100 contributions that you'd make to the Girl Scouts or whomever outside of the supermarket. Not necessarily deductible for everybody anymore, right?
Correct. And so there was the CARES Act that came out in 2020 as part of the COVID response, which they made a lot of changes in a lot of different areas. So, above and beyond just the Paycheck Protection Program loans for business owners, it impacted a lot of people's personal returns, and that there were two basically major ones for charitable giving. One being the ability for people who do not itemize their deductions, they had the ability to deduct nominal amounts of charity for 2020 and 2021. And that is now gone for 2022. It was only for those 2 years. And the other thing that the CARES Act adjusted was, in years past, there's restrictions around how much you can deduct. It also is dependent on the nature of the contribution, whether it's cash directly to a charity, whether it's stocks, et cetera. But for the years 2020 and 2021, the CARES Act allowed for 100% deduction of your taxable income in charitable cash given directly to charitable organizations. And so that was, for a couple of our clients, a very advantageous period of time that, they have charitable giving that they want to achieve, and they were able to kind of ramp up those plans over the last 24 months because they had this ability that they haven't had in years past. It's been 50% or 60% or what have you, but for the last 2 years it was 100%. And so those things, if you are a taxpayer who has taken advantage of those, it's good to be aware that you're not going to have that ability anymore. So you may need to tone your charitable giving down this year if you were reaching your 100% of adjusted gross income threshold.
Great point. And of course, the next strategy here that we call the bunching strategy is really centered around those folks that might not that might benefit from just simply taking the standard deduction in any given year, and rather than giving to charity each year and not being able to get the benefit of that deduction. You might want to say, okay, instead of giving this year in 2022, we're going to double up in 2023 and bunch those contributions together and make a bigger impact in 1 year get us outside of the standard deduction and be able to get the benefit of the charitable deduction that way. So that's what the bunching is. Many folks have heard about donor advised funds, but let's talk a little bit about those for a second, Chris, as well.
Sure. Yeah, and so these are donor advised funds, and then there's foundations, and there's charitable remainder trusts. There's a slew of things that taxpayers, their planners, us as the CPA, we can kind of put our thinking caps on and come up with. And so the donor advised fund at a 30,000 foot level is giving the taxpayer the ability to get a charitable donation, but not necessarily having to give all the money away. If that is enough of a description, Chris, I don't know if you want to add anything else to that, but you get the tax deduction without having to actually give the money away, per se.
Yeah, I think that's a good summary of it. The money goes into a separate account. You can't use it to buy groceries anymore or spend it on buy a car, obviously. But it's put into this fund that's managed professionally, either by the custodian that you've contributed it to. Sometimes if there's a significant amount of money in there, we as advisors can manage it for you as well. But what Chris is indicating is that it doesn't need to go to the charity today. So if for whatever reason you've got a large taxable income this year and you're looking to make a deduction or to get a deduction, but you don't really know what causes you want to give to, a donor advised fund is a wonderful vehicle because you could contribute a significant amount of money to it and not have to worry about it making that decision as to the ultimate beneficiary of it today. You can dribble it out over time. So for many of the clients that we work with here at 12 Points that have wealth, that maybe have sold a business, they're in a really big tax year, we like to put money into the DAF, the donor advised fund, to help reduce current taxation, but also fund future philanthropy. So a really great vehicle, great tool, and definitely something that has seen tremendous growth over the last decade plus.
And for the funds, significant funds that do grow in a donor advised fund, the taxable income on those investments is not something that needs to be paid by the taxpayer.
Right.
So we, again, looking forward, you do get to decide where your charitable money goes. You get to retain the deduction in the current year, and you also can, in theory, take some of your taxable burden in future years on that money off the table.
Absolutely. So Chris talked a little bit about cash and how there was a benefit of giving cash over the last couple of years. One thing that many of our clients and folks that we speak to aren't aware of initially is that there's a real benefit to contributing appreciated securities to charity, right? So if you're able to give a gift to an organization that's a 501c3 that maybe you bought a stock that you bought for $10 that's now trading at $100, rather than giving them a $100 check, you give them that share of stock. You've now avoided that gain on that $90 of capital gain that you would pay tax on traditionally. Just give it to them, let them take it. So it really maximizes the amount that you can give. And for folks that have, the benefit of the last decade, we've seen tremendous growth in equities, certain asset classes more than others, obviously. Those things can be wonderful vehicles to give to charity and reduce your taxable income. So definitely think about those.
We see it a lot with startup founders and employees as well, that they've got ISOs or restricted stock units, or their strike price is 10 cents and the fair market value is $40 in a share. Now there's some ways that we need to effectively acquire the stock, but for those early employees and startup founders and employees at startups that have significant stock compensation, we've used the gift of securities advantageously for their benefit many times.
No, great point. So the QCD, Qualified Charitable Distribution, this is something that has been a real benefit for our wealthier clients that have significant assets in IRAs and are philanthropically inclined. So what this allows an individual to do is to take money out of their IRA without it hitting their taxable income and have it go direct to charity. Make a gift to charity from your IRA up to $100,000. really, really powerful. And for those clients of ours that have, standing pledges or annual gifts that they like to make to certain causes, they don't necessarily need nor want the assets in the IRA anymore. Their lifestyle is met through other needs and other buckets. It's just a great way to take something that's otherwise a tax disadvantaged asset in retirement, right? When you need to pay taxes on it, you just give it away. So you must see a lot of these days, right, Chris?
We do, yeah. And the one other caveat to that I've seen is that we have clients that have done it and they still get a 1099 and they get a little confused because the 1099 has the distribution on there.
Yep.
And so don't be nervous that you got a 1099 and it wasn't supposed to be taxable. It still does get recorded that way, but when we file the tax return, you basically see on the first page it says QCD next to it.
Yeah.
And so it is not taxable, even though they are giving you a 1099.
No, that's a great point. Thank you. And we ended here with this little bullet here of what's the impact. So, I mean, obviously in the world of philanthropy, where I spend a lot of my time, everyone's focused on the impact to the causes they care about, and then to themselves, and to their family. So those are the things that certainly need to be paid attention to. And this next slide here is, change of life. Like, what sorts of things impact your tax return?
Yeah, so the three major ones, right, and it's both ways. It's getting married and or getting divorced, having a kid, or having a child that goes to college or graduates from college and they're no longer a dependent,
Mm-hmm.
and how that impacts your taxes that you've been filing one way for the last 18 years, and all of a sudden you don't have that dependent anymore, and what threshold does earned income for your child that you've been putting into a tax account for them, at what point has that generated enough unearned income that triggers a thing called a kiddie tax? There's a lot of nuances to filing that taxpayers that either A, have been filing separately, and all of a sudden now that they're married, they either get a large marriage penalty or a large marriage benefit, which happens when spouses have inequity in their earnings, that if one spouse makes a significantly larger amount than the other spouse, it a lot of times is advantageous to get married. If the spouses make about the same and they're both high earners, we can have scenarios where there's what's known as a marriage penalty, that you end up paying more tax when you're married than if you weren't. Similarly with kids, there is a lot of, especially for 2021, there was a large child tax credit that was available to many taxpayers. That's changing for 2022. The amount is going down. It was not extended, but there's a lot of adjusted gross income thresholds that go into that. So what may have applied for years past, if you got a large bonus, if something changed in your economic life, things that have applied for years and years now no longer apply. And similarly, the same way too, it's just with the housing market, buying and or selling a house is a significant, or can have a significant tax impact, that when you buy a house and you have a mortgage, your tax deductions for interest, property taxes, those are advantageous for you. And in the same regard, as a primary residence, if you're a married taxpayer, you can exclude the first $500,000 of gain when you sell your primary residence. So all of those things really impact your tax return, even in the slightest, where it's, I moved, or, I bought a new house. It's, well, there's a lot more to it than just, I bought a new house. It's okay. What's your mortgage balance? Or do you have enough, is your mortgage balance over the deductible amount? Do we have to put a limitation on that? All of those things go into it, and really should be conversations that are had with your advisors as you go through the process of buying, selling your home, having a child, thinking about getting married. There's all these things we can really, along with your financial advisor, we can really go through and kind of model these things out, and get you answers to questions that you may have long before you even have the life event.
Great point. Thank you for that. And kind of getting to the end of our allotted time, but we're going to get through these last couple of slides and take a couple of questions, I think. Let's talk about investment portfolio taxation. This is something that is near and dear to my heart.
Yeah, so I'll do the quick 30 seconds tax side, and you can chime in too, but basically the tax loss harvesting what that is, and it's come into, it's a big point of crypto investing, is that tax loss harvesting is basically when you look at your portfolio towards the end of the year and say, all right, I've got $10,000 worth of gain. What positions do I have at a loss that I could sell, recognize the loss, and then offset some of my gains for the year? And then playing into the next point of the wash sale rule, that there are rules around securities that you cannot buy and sell the same security in a period of time, or you don't get the benefit of the loss. And so that does not apply to crypto. And so a lot of our clients, especially as the values of crypto have gone down, have sold and recognized losses on investments that they've sold, and been able to utilize that as their tax loss harvesting strategy over a period of time.
That's interesting. Do you consider that something at risk going forward? I mean, that seems like an obvious thing that could be changed, right?
The IRS came out and said that crypto is treated as property, meaning the same way that it would be treated as if you bought and sold a house.
Okay.
So there are, for the time being, I don't have a good answer to that. I think certainly there's going to be more focus on it as you have more and more people getting involved in the space, A, and B, just with the enormous returns over the last 10 years, call it, there's a lot of people with a whole lot of money in the space that, you know, by and large, the government's going to want their cut of.
Yeah, no doubt. No doubt. And, you know, one other thing that I would add here to this slide is very simply the importance of tax location, right? So, you know, if you've got an IRA or a 401k and then a taxable account, what we really like to do for our clients is to look at the things that are going to generate the most taxable income, and try to stuff that into a vehicle, whether it's an IRA or a 401k. It's going to avoid the taxation on that and get the tax deferral to the extent that we can. You know, sometimes you can't do that as much as you'd like, but if you do have that flexibility, it's wonderful. And then own the things that are more long-term capital gain, where you're not necessarily going to be getting general taxable income on the regular, i.e., you know, stocks in the taxable account, bonds in the 401k would be, you know, just good basic sort of tax location stuff. So those are really important. And as well as we just talked about, you know, the importance of long-term capital gains versus short-term. You know, if you own a security for under 12 months and sell it, and there's a gain, it's going to be a short-term gain, meaning taxed at ordinary income rates. Anything over a year is typically viewed as a long-term capital gain, with a long-term capital gain rate, a huge benefit to those of us that hold things for a while. And just kind of touched on this.
And yeah, the one other thing on the short-term capital gain is there's a higher rate in the state of Massachusetts for short-term capital gains.
Great.
So really be conscious of those as you sell them. You know, if it's, we've had clients that have spent a difference of 4 or 5 days that they just didn't realize it. And you know, they're day trading in their E-Trade account, and it ends up costing them a significant amount of money not paying attention to dates.
Yep, no doubt. So we kind of touched on this a moment ago before with, you know, additional tax deferred savings. So, you know, aside from your traditional 401k or 403b at work, there are things that can be done to minimize your taxes in the form of retirement plans. Traditional IRAs, you know, those non-deductible IRAs that Chris was discussing earlier. It's amazing to me how many people I speak to that are very, very smart in their career and just wildly successful, but they're unaware of the fact that each year, even if they're a participant in a 401k, maybe they own the company, even that they can contribute, you know, $6,000 plus $1,000 catch up to an IRA each year. It's not deductible, but it grows tax deferred. And if you do a backdoor Roth conversion and turn it into a Roth, it grows tax free. And you can do that not only for yourself, but for your spouse. You can put $14,000 away every year going forward until retirement. That's a huge benefit that's overlooked by so many people. If I had $1 for every time somebody said to me, well, I have a 401k, I can't contribute to an IRA. Wrong. Roth IRAs are awesome. as we talked about. You get tax-free growth. I'm sorry I interrupted. You were going to say something, Chris?
No, I said that's a great point. I was just corroborating what you said.
Thank you. SEP IRAs are great vehicles as well. And then, of course, the 401ks, defined benefits, all of these things. So, from our perspective, just pay attention to the ways to fund your retirement, minimize your taxes. But it's not all about just income taxes, right? So we talked a little bit about capital gains. Really, really important to pay attention to, especially for business owners and serious investors. As Chris described, there's those intricacies with regard to crypto that I was not aware of. I think that's awesome. And of course, the area that is really near and dear to my heart is estate and trust and gift planning, gift taxes. That's a world that has been on the back burner for the past several years because the estate tax exemption for a married couple has been upwards of $22 million. So hasn't really impacted that many folks, but it's going to, again, for certain. So the current estate tax laws will sunset in December of 2025 and revert back to the rules prior to the Trump administration, which was around 5.5 million. Adjusted for inflation, it should be around 6 million per. So we're going to get a reduction in half anyway on the estate tax. So, that's a huge, huge thing to pay attention to for wealthy clients. There's lots of planning to be done there. That's where I'm spending lots of my time and energy, and simply love it. So if those are questions that are on your mind or family members, people let us know. We're going to take a couple of questions here. There's one that I think is a really great question. Does the HSA, not the FSA, account have an expiration? There was a question that said, is it forever? I said forever. So the question was, if I leave my job with thousands of dollars in it, can I keep it? The answer is yes, absolutely. There's no expiration to the HSA. The reality is that you're going to want to spend that money in the future, right? Because you put it away, it grows tax-free for indefinitely, as we said, and it comes out tax-free if you use it to reimburse yourself for health-related expenses. Trust me, you will have health-related expenses when you're older. So by all means, take advantage of the HSAs now. Don't see any other current questions. If you've got one, please let us know. As I said, here is our contact information. So Chris Cahill, Chris at 12pointswealth.com, and Chris Lee is Chris at leeandcrowley.com. I'll leave this up here for another moment. And then this presentation also has at the end of it some important information relative to changes of income tax rates for individuals, married couples for 2021 to 2022. Also, capital gains rates, qualified dividends. AMT we didn't touch on, that's a masterclass in and of itself. The standard deductions we did touch on a little bit. And of course, IRAs, tax deductibility of IRAs, etc. Clearly too much for us to cover all in this presentation. The intricacies of these qualified plans, estimated taxes, etc. But know that we have this. This is on the presentation. It's now, you've seen it here. It'll be recorded and saved on our site. Let us know if you'd like a copy of this. We'd be happy to share it with you. And without further ado, I'm going to let you all get back to your day and say thanks again, Chris. Great job as always. Appreciate it. And good luck getting through the rest of your tax season.
Thank you. Yeah, appreciate you having us. And if there's anything that we can answer for you or anyone else, please don't hesitate to reach out.
Wonderful. Have a great day, buddy. Talk to you soon.
Thanks, you too.
Thanks. Bye-bye.